Alright, next, capital and financial account. It is actually into two parts, capital account and financial account. Capital account consists of capital transfer and acquisition or disposal of the non-produce, non-financial assets. So things like, for example, patents, copyright, and trademarks, right? It is actually considered as intangible assets. The non-financial assets could be also the tangible asset, like, for example, land. Then the next one is actually a migrant transfer of fixed assets due to migration, meaning to say that if actually one person migrate from one economy to another economy, so the amount of fixed asset that he has in the economy initially, right, will be transferred to the next economy. Alright, next is actually the financial account. It records the international investments and the transactions in the financial assets and liabilities, both in the long term and in the short terms. So therefore, it could be the transaction related to the international movement of the ownership of a financial assets, or refers to the cross-border movements in the financial instruments, as mentioned over here, like ownerships of shares, bank deposit, bank loans. So, for example, if they were to, or if there is a purchase of the foreign assets, right, it is actually known as capital outflow, and and it is recorded as a debit item. The reason is because when we purchase the asset from the other economy or from another economy, the amount of money in our economy actually flow out of our economy. So therefore, it is considered as a debit item. Next, the foreign investment in the country are capital inflow, meaning to say the foreigner invested in our country and the money, the currency from their economy actually flow into our economy. So therefore, it is actually considered as a credit item. So as mentioned, it is actually divided into short-term and long-term capital flow. So for the short-term capital flow, it includes the bank deposits, the short-term loans, and as well as the treasury bills. So it is actually usually with a maturity of less than 1 year. The reason why we do have this term, or rather it is known as the short-term capital flow, is because the movement of these short-term capital flows are made in response to the interest rate differences between the countries, the anticipated exchange rates movement, and due to the fear of political instability. So therefore, in a nutshell, it means that because of the nature of being short term with a maturity less than 1 year, so therefore it's easier to move the capital flow from one economy to another economy. Next, it is the long-term capital flow. It actually records items like direct investment and portfolio investment. So direct investment, right, it actually refers to the acquisition of the long-term controlling interest in an enterprise located in another country. So it has a more long-term, or rather it implies a longer-term relationship between the investor as well as the direct investment enterprise, and hence it will have a more significant influence on the management of the enterprise. So therefore, the country investment overseas, right? When the country invests something that is overseas, it represents an outflow of the money from the economy. And on the other hand, when the country or investment by the foreigner in our country is actually represented by an inflow of the money. So therefore, it is actually recorded as a credit item in the financial account. Alright, next, the portfolio investment. So it actually includes items like, maybe for example, equity securities such as the stocks and shares, and debt securities in terms of like the bonds and notes and money instruments. So all this, right, if for example, if the resident in our economy actually buy foreign securities, so this is the securities is actually offered by the foreign economy, so it is actually considered as a outflow, money flowing out of our circular flow of income, and therefore it is recorded as a debit item. So on the other hand, when non-resident or people buy securities that is issued by our country, by issued domestically, it is is recorded as a credit items in the country financial account. So therefore, whether it is actually under financial account or capital account, it depends on the nature of the goods itself. So for the financial account, it refers to the financial assets. Then on the other hand, the capital account, you are looking at the capital assets, the flow of the capital assets. So let us look at one example and to identify that whether these are actually credit and debit items. So in this case, for the long-term capital flows, any investment made in UK, so assuming that UK is the economy that we are talking about, so investment in the UK from abroad, it is considered as a credit item, So meaning to say that the foreigners actually invested in items that is offered in UK economy. So therefore, it is actually the flow of the money income from the foreign country into UK, and therefore it is a credit item. On the other hand, net UK investment abroad, in this case, it actually refers to UK investment made by the UK resident in UK, but they invest on items that is actually out of the UK economy. So therefore, it is actually money flowing out of our economy, and therefore of UK economy, I mean. So therefore, it is actually a debit item. So the short-term capital flow net transaction, in this case, so we are looking at the difference. So for the long-term capital flow, it is actually a negative of $40,792. Then with the change or the net change over here is actually a positive $38,085. So therefore, in this case, the capital and financial account, the difference, or rather it's not the difference, it's the addition, is actually a negative $2,707. So this case is actually a case of a deficit in the capital and financial account. So is it a bad thing to have a deficit on the capital and financial account? Actually, not necessarily. It depends. So if the deficit is due to the long-term investment from the other countries, this will actually generate future income from abroad, and therefore in future it will be credited under current account, under the income that is earned by the people in future. So therefore it is not a bad thing to have a deficit in the capital and financial account. So therefore it depends on what is the deficit, what would be the cause of the reason for the deficit. So if it is due to the long-term investment, it will be good in future. So let us look at overall. In this case, we have actually gone through the current account, and this video we actually look through the capital and financial account. So therefore, when both there is a negative, or rather when both are added up and is actually less than zero, it is known as the balance of payment deficit. When both current account and capital financial account add together with a number that is less than zero, which is negative, it is actually balance of payment deficit. On the other hand, if it's actually more than zero, it's actually a balance of payment surplus. So it is actually positive. Then if the difference between, or the addition between of both current and capital and financial account is equivalent to zero, it is whereby the balance of payment is actually at equilibrium. So if the sum of the current account and capital and financial accounts balances is zero, balance of payment is said to be in equilibrium. So therefore, to summarize what we went through, balance of payment is actually an accounting statement based on double entry system. So the total outflow of money must equal to the total inflow. So therefore, balance of payment should be at equilibrium for the economy.